Let's talk to Mike Ingram. He's the Chief Market Strategist at WH Ireland. Mike, very good morning to you.
Morning.
Right, let's talk about global equity markets. You're the Chief Strategist. What on earth's going on?
Well, quite a lot's happened over the 2 weeks since we last sat down, hasn't there? Interesting one. I mean, you know, I've been on this show for years, and we were always saying, well, the market is it's very, very low volatility. In fact, you know, this shorting volatility has been a trade for many, many years. It's tended to be quite profitable. But we also mentioned that, you know, the market hadn't been pricing in the Fed dot plot. And in fact, last year was the first year that we've seen the Fed actually deliver on their dot plot, three rate hikes. Yep. But they weren't discounting three until this year, until relatively recently, and they're still not discounting three for 2019, for instance. So there were the conditions were there for a bit of a bond market meltdown. And what was interesting is one of the things that I look at, for instance, is the so-called MOVE index, which is if you like, the US Treasury equivalent of the VIX for equities. And that started moving up in a meaningful fashion in the second half of January. Now, there are a number of events which helped to catalyse that upward movement, that increase of implied volatility. So, for instance, one of them was, you know, these comments from Steve Mnuchin and Wilbur Ross out of the Trump administration seemed to favouring a weaker dollar at Davos. Yep. Another one was actually the passage of the US tax reform, which was, you know, of course, of itself a positive thing for equities. I mean, a lot of companies are going to get better earnings because of that. But again, inflationary, I mean, in principle, the US could well be looking at $1 trillion deficit this year. That's about 5% of GDP, which is, you know, a big deficit, even if you're, one, not the biggest country in the world, and two, very late on the economic cycle. And then I think the straw which broke the camel's back quite clearly on that Friday before the Monday plunge was that non-farm payroll wage number, which I think, you know, there are a few adjustments which could be made. It could be revised down, but, you know, the market was already primed for, you know, a bond market was already primed for a blow up. That was the straw that broke the camel's back. And then we had the ripple effect into equity and so on and so forth. And we had mass liquidation of short volatility trades and so on and so forth. So let's see how this settles down. I mean, one data point I'm going to be particularly looking at going forward is the US inflation number for January, which was on Wednesday. The headline number is expected to come back from 2.1 to 1.9% year on year. And the core number is expected to tickle down from 1.7 to 1.6. Now, of course, if it goes the other way, yep, then we're back on high alert again. Right. In any event, I would certainly expect volatility to come down from levels we've seen recently in the weeks ahead. You know, as I said, Wednesday's a bit of a potential spanner in the works. But I very much doubt we're going to get down to anything kind of the levels that we saw, for instance, in the last quarter of last year, because it was almost impossible to go lower. And a lot of the investment vehicles that were used for channeling those short volatility trades into the market are blown up. A lot of them have been liquidated. Yep. And let's be honest, a lot of it was momentum trading anyway. Yep. We were in that melt-up situation. That momentum, and I'm not a chartist, as you know, but a lot of chartists will be going, well, it's completely broken down. There's nothing to, you know, there's no obvious support here. So, you know, it's a change in market conditions. It's a change in market psychology. I'm not saying that markets can't recover from here, because at the end of the day, the global economy is doing pretty well. Company earnings are coming through quite nicely, particularly in places like Europe. We've actually had 3, you know, economic upgrades so far this year in the US, Japan, and the Eurozone. So, you know, there still seems to be momentum there, but it might be quite a long crawl back up to levels that we saw only a fortnight ago.
Interestingly, I've been talking to a number of commentators, and everyone, the consensus was we're in the 9th innings in baseball terms, the last innings in the bull market. Some people said, actually, no, it's different this time. We're in the first innings. There's still plenty of upside. The risk, I guess, at the moment is that final sort of phase of a bull market. If you take money off the table, you could potentially lose circa 30%, okay, of that upside. But in terms of your clients, okay, what are you saying? Are you telling them actively to take money off the table, stick to the dividend yield, you know, the decent payers, or exposure in Europe generally? Because obviously, if I read the headlines, if I've read the Sunday press at home, okay, I think, oh my God, what's going on? You know, I've lost everything.
Well, I mean, I hesitate to offer investment advice, because obviously people's investment needs and criteria, you know, differ enormously. I mean, I would still stick to the adage that, you know, it's time in the market rather than timing the market. Of course, I would say that anyway. But historically, when we've seen these sorts of pullbacks, and I'm not even talking in the post financial crisis QE, central banks, dosing you up with the old punch bowl era. I'm talking about even prior to that. You've usually managed to sort of get decent positive returns in the 6 months after this kind of pullback. I think the sort of the broader issue actually is that certainly in terms of the US, certainly the economy is in the ninth innings. I mean, this is the third most longest financial expansion in recorded history in the US. And although there is this idea that these expansions don't die of old age, I think there are plenty of signs to suggest that the glory days are over. And as I say, certainly in the US, perhaps for slightly different reasons I've indicated, the growth inflation trade-off is no longer that favourable. I'm not unhappy about that because I've been a little bit somewhat sceptical about the US and generally speaking, I'd rather be somewhere else in terms of investment opportunities. But the issue, as we've seen very clearly over the last couple of weeks, is to what extent can other markets decouple from what is going on within the US. Now, I'd have to say, just to bring it back home, the Bank of England didn't help last week either, because the Bank of England, although it was that nice, dovish 9-0 vote on keeping rates on hold at 0.5%, they moved the goalposts. They brought they have done it before, but not recently. They moved the goalposts in bringing their inflation back to target from 3 years out to 2 years out. And they were doing that in an environment where the bond market was already, falling out of bed. So, for me, it's putting fuel on the fire.
Yep.
It's made you've gone from a situation where we thought we knew what central banks were going to do. Now we're less certain. And you have to wonder where this is going to be a global issue, because one of the things that was hidden away in the press conference on Wednesday last week from the Bank of England was they were musing publicly about what something which sounds boring, but it's very important, the long-term equilibrium real interest rate is. Now, to put it very, very simply, the working assumption at the moment is that zero. That real long-term rate is zero. Historically, it was of the order of about 2%. 2% real interest rate. So we're stripping out inflation. But if you sort of say, well, maybe it's going to go up, all of a sudden, all these people's thinking, well, maybe we're happy buying gilts at 1.6, say, on a 10-year. All of a sudden, you're not looking at 1.6, you're looking at 2.6, or maybe even 3.6. I mean, we're worried at the moment about quarter-point rises. So, these central bankers, they haven't proved to be terribly reliable. Okay, in the US, they've had a lot to deal with.
Yeah.
In terms of the Trump administration and also the way that the market is hardwired. But for the Bank of England, etc., it seems to be a bit of a self-inflicted wound. And of course, they are doubling up very heavily on a smooth transition around Brexit. So, I've lined myself up for our next chat moves, I suspect.
On that note, Brexit, we'll have chapter 2 in 2 weeks' time. Mike, Thank you very much indeed for your time.